Will there be a recession and how that would affect home prices?
Ladies and gentlemen, this is Athena Dinh with DINHOMES. In this recording, we're going to address our latest housing market update. We're going to do that by jumping right into the news. If you've been watching the news lately, there has been a frenzy and a lot of talk about the recession. Very obviously, the yield curve is inverted, and that's a sign that there's a recession around the corner. That, coupled with, on August 14, the stock market dropping 800 points and then bouncing up and down since then, has caused a lot more conversation about recession. So in this recording, we're going to take a look at what is actually happening with prices, home prices, because that's what people are really concerned about. If there's any sort of economic slowdown, how will it affect prices? Well, if you take a look at this chart, ladies and gentlemen, if you take a look at this FHFA quarterly report, the year-over-year change in prices, you see that every single region is seeing positive. Every single region is seeing appreciation. So there's some talk out there because the level of appreciation has decelerated. Some people are changing that and making believe it's like depreciation and not understanding it and using the word depreciation. But if you take a look here, you'll see there isn't any depreciation in any one of the regions. As a matter of fact, each region is greater. The appreciation is greater than the normal historical norm of about 3.5, 3.6%. If we break it down by state, we have very much the same situation. There are no red states. There's no depreciation over the last year, meaning in every single state, prices kept on appreciating. Now, the level of appreciation has slowed, but there's nobody going into depreciation. When we're thinking about pricing overall, across the whole country, pricing is still good. Now, I will say that the change in price, the amount of appreciation is pretty much determined by what sector you fall in, what category you fall in, because price range matters. The lower price houses that have the least amount of inventory and the greatest amount of demand, they're appreciating much higher as we go up in price, obviously. There will be less buyers that could afford those houses, and there's more and more inventory because of that. We can see that as we go up in price, the year-over-year change in price, the amount of appreciation actually goes down the higher we get, as shown in this graph here. Now, if we go to the month supply by price range, you say, wait a minute, shouldn't the low price month supply be lower since pricing is accelerating even more? Well, there's actually a story to this graph. There's one little caveat there. In the low price, what has taken place, ladies and gentlemen, is the fact that there's a lot of low price inventory that for the millennial buyer or for the Generation Z buyer is just not appropriate. Millennial and Generation Z buyer want something that's fixed up. They don't want something that they can go in and renovate. They want the finished product. So even though the inventory on the low price range is a little bit higher, the reason prices are still going up is some of that inventory to most of the buying population is not sellable. The good news is mom and pop investors are buying that inventory up, fixing it up, and flipping it. They're making it so that when they put it back in the market, it is something that millennial buyers, first-time home buyers, or even move-down buyers would purchase. As mentioned, overall, pricing is still good. In fact, according to Molly Bossel, the principal economist at CoreLogic, home prices have increased steadily since 2011, creating record amounts of home equity and putting homeowners in a good position to weather future downturns. Now, the reason we want to talk about this is you're going to see some studies out there that say that mortgage debt is at an all-time high, and that's true because we're buying more and more houses and more expensive numbers. The per person, per capita number is still very, very low and close to historical lows. But you're going to read those reports, and we want to counter those reports by saying, yes, there is more mortgage debt, but there's more equity also. In fact, if we take a look here at the average annual equity gain year over year per borrower, you'll see that in 2011, that was the last year that prices depreciated, of course. We lost equity. Ever since then, if you own a home, you gain equity. As a matter of fact, In the first quarter of 2019 alone, according to CoreLogic study, just in that first quarter, people gained over $6,000. Now, if we take a look at it overall, how much equity do people actually have? Capital equity of U.S. mortgage holders in the billions, all right? That has risen dramatically since 2011, up to $6.3 billion of equity in this country right now. Now, if we take a look at it overall, how much equity do people actually have? Capital equity of U.S. mortgage holders in the billions, all right? That has risen dramatically since 2011, up to $6.3 billion of equity in this country right now. So, when people talk about how the housing market could be impacted if the economy slows down, well, ladies and gentlemen, people have $6.3 billion worth of equity. That's a different type of situation than we saw previously. So I think that alone, especially when you take a look at how many people actually own the house with more than 50% equity. Did you know that 50% of the homes today have more than 50% equity in it? Nobody is walking away from those houses if things get tough. As a matter of fact, let's take a look at another chart. Let's take a look at the negative equity share. Back in 2010, that number was up to 25.3%. 25.3% of the people had negative equity in 2010. And that number has fallen dramatically all the way down to 4.1% in the first quarter of this year. So the good news is there are less and less people that are in a negative equity situation. And I think that prices are going to continue to show very well. According to Dr. Frank Notoff, chief economist for CoreLogic, he said, with incomes up and current mortgage rates about 0.8 percentage points below what they were 1 year ago, home sales should have a better sale pace in the second half of 2019 than a year earlier, leading to a quickening in price growth over the next year. So, two things that we're hearing there. Number one is appreciation is still going to be there. And number two is the amount of sales because mortgage rates are going down. According to Ralph McLaughlin, CoreLogic Deputy Chief Economist, he said, we see the cool down flattening or even reversing course in the coming months and expect the housing market to continue coming into balance. As a matter of fact, if we take a look at this chart here, CoreLogic forecasted year-over-year percent change in price. Over the next 12 months, they break it down by state. For the entire United States, they say that the values will go up 5.2% over the next 12 months. Now, if we take a look at it, the only state that's even a question mark because it's going up less than 2% is Texas. Each one of the other states are either light blue, medium blue, or dark blue, meaning they're going to see very nice appreciation. So no one is projecting that over the next year, prices are going to come tumbling down. If we take a look, it's not just CoreLogic, but the other 6 resources we use are projecting the same thing. They're all saying that there's going to be continued appreciation. Lower appreciation, but continued appreciation over the next 4 years. No one is projecting that prices are going to fall. No one. Now, ladies and gentlemen, what we have to realize is a recession is going to occur. We're on the longest economic expansion in American history. The only thing that will stop the expansion, the term that will stop it, is an economic slowdown. For 2 consecutive quarters, GDP goes down. There's not anything to be afraid of. But when people hear the word recession, they're going to be thinking about 2008. But it's different. According to Jeff Tucker, the Zillow economist, he said, the housing crash during the Great Recession left a lasting impression, but as we look ahead to the next recession, it's important to recognize how unusual the conditions were that caused the last one, and what's different about the housing market today. Rather than abundant homes, we have a shortage of new home supplies. Ladies and gentlemen, right now we as a nation have about 4 months supply. Back in 2006, 2007, we had over 9 months supply. Rather than risky borrowers taking on adjustable rates mortgages, we have buyers with sterling credit scores taking out predictable 30-year fixed-rate mortgages. The housing market is simply much less risky than it was 50 years ago. And there's something else that we came across. Take a look at this chart here. Did you know that 37.1% of the houses in this country right now don't even have a mortgage on them? More than 1 out of 3 of the houses, if you look in your neighborhood, 1 out of 3 of those homes, on average, don't even have a mortgage on them. We're in a different time. Back then, people were taking out mortgages, using their house as an ATM. They were buying jet skis and new cars and going on lavish vacations. They were trading in the equity on an appreciating asset and purchasing a depreciating asset. Remember, we already told you that equity in homes is skyrocketing because people are not making those same stupid mistakes. According to George Rashu, the senior economist at Realtor.com, he said, "This is going to be a much shorter recession than the last one. Well, I don't think the next recession will be a repeat of 2008. The housing market is in a much better position." Now, if we take a look at this home price change during the last 5 recessions, yes, in 2008, prices dropped 19.7%. But we have to remember that in that last recession, it was caused by a mortgage market meltdown. But in 2001, the stock market lost almost 25% of its value during that recession. Yet prices went up 6.6%. So, people are projecting over the next 2 years there's going to be a recession. And that's probably going to be the case. No one knows for sure, but it seems that it's going to be the case. But let's take a look at the next chart. Okay, this next chart here, ARCH Mortgage Insurance. They do a study every single month where they say, what's the probability of home prices being lower in 2 years? And they rate them moderate, low, or minimal. Take a look at the map. There's not one state that's even moderate. It's either a low probability or a minimal probability that prices 2 years from now will be less than what they are today. And according to Mark Fleming, First American's chief economist, if the 30-year fixed rate mortgage declines just a fraction more, consumer house buying power would reach its highest level in almost 20 years. So as you can see, all the survey agree prices are going to remain solid. Appreciation is going to decelerate. As a matter of fact, now they're saying it might actually reaccelerate a little bit going into the end of the year because there's still lack of inventory. But prices are going to remain solid for the next 2 years. Mark Fleming also said consumer house buying increased by $44,000, 12.2% last month compared with 1 year ago, more than enough to overcome the 7% increase of nominal house price appreciation. In fact, house buying power is the highest it's been since we began tracking it in 1991. So if you're a buyer and you're thinking that real estate is unaffordable because of price, you have to remember that affordability isn't just a price. There's an equation. There are 3 pieces of that equation. Home prices are one. Wages, how much money you're making, is another part of that equation. And maybe the most important part of the equation is interest rates, which are now down almost a full point from last year. Yes, prices have gone up, but interest rates dropped like a rock. To summarize this recording, let's revisit what we talked about. Based on the surveys, a recession is around the corner. However, prices will not depreciate. Prices will continue to stay solid. It will accelerate and decelerate. However, it will not depreciate. This is still a great time to buy and sell because prices are still affordable because interest rates are still very low and wages are still really good. Our goal here is to be able to explain things simply and effectively so that you, as a consumer, whether it be a single person or a family, can make the right decisions. Thank you so much for your attention, and as always, we hope this information was valuable to you and the people you care about.